Underwriting can be a difficult task for the new investor or the seasoned investor, but unlock the potential of commercial multifamily real estate underwriting with the guidance of a seasoned professional. Introducing Daryl Murphy SR, a dedicated multifamily underwriter and coach with a wealth of experience in the field. Daryl brings you the tools, knowledge, and personalized coaching necessary to navigate the complexities of multifamily investments. From financial analysis to strategic investment planning, Daryl is here to guide you every step of the way. Whether you're aiming to expand your portfolio or taking your first steps into the underwriting world, Daryl's expertise will help you make confident, informed decisions and maximize your investment returns. Start your journey towards real estate underwriting with Daryl today and transform your investment dreams into reality. Daryl's contact information is in the description now. Let's get started with the Commercial Multifamily Masterminds meeting with guest speaker David Monroe.
Hello, everyone. I would like to welcome you to the Commercial Multifamily Masterminds. We are an affiliate of the GOB Network of Apartment Investors. I am your host, Daryl Murphy Sr. Alicia Milton is our co-host. And today we do have a special guest that we're going to be discussing underwriting. So as I stated, we are a member of the GOB. What is the GOB? The GOB network seeks to, it says to seek to democratize commercial real estate, right? Via mentoring and deal making. However, the GOB mission is to provide education, network support, and opportunity for investors who's ready to take that plunge, who's ready to get into the commercial space. Okay, that's basically what the GOB is about. To provide you with the education, network, support, and opportunity. Okay. So what is the mastermind? What's our mission here? Well, our mission here is to get rid of that competitive mindset. That's the main thing, to get rid of that competitive mindset. So here we are going to also provide you with education. We're also going to provide you with network. We're also going to provide you with support and opportunity. All right. But the main thing is, can we work together? Can we work together as a mastermind to take down these opportunities? Okay. So the mastermind principle, the coordination of knowledge and effort of two or more people who work toward a definite purpose in the spirit of harmony. Now, if you're familiar with Napoleon Hill, Think and Grow Rich, right? Then that's where this quote came from. And that's the mastermind principle that we take here. Disruptive thinking. T.D. Jakes says, a team is composed of like-minded people with different skill sets, but equal commitment toward measurable outcomes. So here in the Commercial Multifamily Mastermind, we have different people here that can also help you with your investment opportunities. Okay. So let's discuss that. All right. Let me see. Who do we have? Let me see. Are any of my family members? I like to call them family members. And if they're not, we shall continue to move on. I don't see anyone here. All right. So let's continue to move on, because we do have those that we have cost segregation, we have lenders, we have other people that can help with you getting that investment across the finish line. Okay. All right. So, hold on one second. Let me. Okay, I had to. Uh, okay. So right now, the normally I will go through my Facebook page, to show you that we do have a Facebook page and everything. But right now we can't. I can't access it. It appears to be a global outage, right? So no one can access. I'm not gonna say no one. I can't access the. Uh, I can't access Facebook. However, I can access commercial multifamily masterminds here on YouTube. And so listen. I'm trying to get to 1,000 subscribers. If you're not, if you have not subscribed to the commercial multifamily masterminds, I would like for you please come over and subscribe, ring the bell, as they say. They say subscribe and ring the bell. So please come over, subscribe, ring the bell, get me to 1,000 subscribers. All right. But here on our page, as you can see, we have different guest speakers. We have the capital rate strategy session where we have guest speaking there. Then we have guest speakers in reference to underwriting and so forth. So come on over here and look at some of the videos and get educated on underwriting. Now, today we have a special guest. I've known David Monroe, I'll say for a couple of years now, and he is an underwriter. Well, I know him. He's deep in his underwriting. I like the way he he thinks when it comes to underwriting. I like the way he does things, and I over I'm gonna say the past couple of days, I reviewed his 3 videos in reference to underwriting. So he has a different. Everyone underwrites differently, but I like the way he underwrites, and as we all know, this the commercial multifamily mastermind. We specialize and we only look at underwriting because to me, underwriting is the most important thing. Even before capital raising, I think underwriting is the most important thing. So let's take a few minutes. Let's welcome David Monroe to the Commercial Multifamily Masterminds. And David, would you please give us a little background on you, on who David Monroe, CCIM, who is David Monroe?
Well, thank you, Daryl. Appreciate the invite for being here. And we've known each other for 3 years.
3 years. I know it's a couple of years.
3 years. Back when GOB was first getting started.
Yeah.
One of the original founding members, if you will. So me, who am I? I'm just me. I got started in commercial real estate in 2011, December 2011, got my real estate license in March of 2012. I did a single family flip. I had a single family rental. I sold a couple of single family houses as a broker, and immediately transitioned into commercial because I knew that's where I wanted to go. Also knew I wanted to go into multifamily, so I tested everything just to make sure that's where my passion was going to lie. So I sold a couple of retail properties in my local market, which is Mobile, Alabama. I sold an office. I sold an industrial, a couple pieces of land, and realized that, yep, multifamily was something I wanted to do. And by September of 2013, I was 100% full-time multifamily and never looked back, never did anything else.
Right.
So I'm vertically focused, meaning it's nothing but multifamily. I've brokered multifamily. I've invested in multifamily as a syndicator, as the primary sponsor, as well as a passive investor. When I used to take my commissions on brokering multifamily and put my commission into the deal as a passive investor. I've also joint ventured on multifamily, and I owned a property management company for multifamily for a period of time in 2016, 2017. So that's what I mean by vertically integrated. In 2021, I started my education program for education, mentoring, and coaching because the crap that was being taught in the community in the multifamily space was just that. It was crap. And I thought we needed a fundamental approach. So you say my way of teaching is different. It's not different. It's the fundamental principles that are taught by the CCIM Institute and that are taught by the MBA programs around the country. And I can say that because those MBAs around the country, there's 135 universities that use the CCIM curriculum as their curriculum for their real estate MBA programs. So that's what I do. I teach the fundamental principles when investing in multifamily, whether it's underwriting, whether it's asset management, acquisitions, property management, getting a loan, whatever that is. So anytime you see anything, especially on my YouTube, where all of my education is located now for free, it's all on fundamental principles using a data-driven approach.
I'm glad you that part I love when you said data-driven approach, because you know I look back on myself when I first got started into underwriting, and um I was at first I wasn't data-driven because although I was taught, okay, to pick a market, to pick a market and learn that market and build relationships in that market. The one thing that wasn't taught to me was what specifically I needed to know in that, to pick a market. So when I finally started learning the Neil Bauer way, and I'm gonna call it Neil Bauer, the way Neil Bauer is, because I love the way he does it. Once I started learning the way Neil Bauer was picking markets, and the way he was teaching it, I immediately grasped to it because it gave me what I needed. When you look at your when you say data driven, and this is I want to get into the market first before we dive into the underwrite. When you say data driven, looking at a particular market, what data do you look for in a particular market before you say, hey, I will invest, in this particular market? What data do you look for?
So there's some data we can look at economically as well as demographically, even psychographically. And a lot of people will not invest because they've been taught not to invest in populations under 50,000. Now, do you know what that number represents, 50,000?
What it represents?
That is what a metro statistical area starts at. It's 50,000 population plus. That's a metro statistical area. A micro statistical area is from 10,000 to 50,000. And then rural areas are areas that are below 10,000. There are 396 metro statistical areas in the United States, and there are 592 micro statistical areas in the United States. I don't care whether it's micro or metro. It's irrelevant to me. It just depends on what is in that specific market. Remember, every market is different. One of the things, if you ever get around me for any period of time, you will know that I think rule of thumb is an absolute bull BS metric. There's no such thing as a rule of thumb across the country. Now, you may have a rule of thumb in a specific market, but every market is different. So I'll look at population, see what the population is. More importantly, I'll look and see what the rental population is for that, also known as what we call tenure, which is your owner-renter ratio. So I look at that. Then I'll look at how many households are in the market. I'll look at population, look at households. That'll give me my number of people per household, but census gives us that. Then I will look at the non-household population in the market, such as prisons, student housing on campus, military on campus, things like that. That way, I know I need to subtract from the population to get my households. Once I know my households, I can add my tenure to it, that owner-renter ratio. That tells me how many households are needed based on that population. From there, I can do a demand analysis, a current demand analysis in the market. I don't need Neil Bawa. I don't need Dr. Muller or anybody else to tell me what that market should be or what that market was 3 or 4 or 5 years ago. I can look at it today and know what it is today. So I'll look at that. I'll look at and determine what the demand's going to be. A bird just hit my window. Then I'll take that information and I'll look at the employment, see what the employment looks like in the market. Is there employment growth? But more specifically, is it export category employment growth, otherwise known as basic jobs? Because not all jobs are created equal. But if money is coming from outside the market, in the market, and feeding the employees in the market, which spends money in the market, that's the kind of employment that matters. Is there growth there? Is it stagnant or is it declining? Because that does affect population with a multiplier effect. And there is a way to calculate that multiplier effect that goes way beyond the scope of today's class, because we'll be here for 2 hours with me teaching how to do that. But I'll look at that and ensure that it is at least not declining. If it is declining, that may be a market for a master lease option strategy, because master lease options are good in declining markets. But for anything that I want to do, it's going to be either steady or growing, and that's how I determine it. I don't look at the past. The only thing I look at in the past is what we call shift share. So I'll look at shift share and see how the employment grew or shrunk during a period of time. And what I like to do is I like to look at the recessionary cycles. So I will go back and look at lagging data, but that's all I look at. I look at each recessionary cycle. How did employment, especially for the economic-based categories, those export sector categories, how did they grow or contract during the recessions? Because in the next recession that's coming, I can start to identify trends. And so that's why I look at that data. So that's how I start to identify whether a market works for me or not. And then I'll go look at supply. Once I start to identify supply, now I can start to identify gaps between demand and what's actually existing, and if there's an actual opportunity or not. And then I go from there. So that's how I attack markets.
Fantastic. I want to go back to something that you said. You said you look at tenure, because I don't hear too many underwriters speak of that term tenure.
I'm
Can
gonna
you go?
wager a guess that you've probably heard nobody say it before.
Yeah, no one but you, right? So let me just delve on that just a little bit. Can you be a little more specific? Because I don't know, maybe everybody else here have heard of someone looking at tenure, but can you explain it just a little more for someone who may not know what you mean when you say I look at the tenure?
Tenure is the census, US Census definition for
Mhm.
owner-renter ratio. You need to know what the renter ratio is in the market. Otherwise, how are you ever going to do a demand analysis? How do you know if there's a demand supply imbalance? You don't. So that's one of the most important calculations when figuring that up.
So okay, I got you. So the owner renter ratio, and what would the owner renter ratio need to be for you to say okay? Is there a particular number?
It needs to have demand in the market. The number's irrelevant. Again,
Okay,
you're trying,
got you.
what you're trying to do, Daryl, is you're trying to put a rule of thumb to it. You can't. Every market's different.
No, the reason why I asked that, the reason why sometimes you hear me try to drill down on a number
Yeah.
is because, and I'm gonna go back to me. When I first got into uh commercial real investing in commercial real estate 7 years ago, The only thing that was ever said to me, you want to see population growth, you want to see job growth, you want to see this, you want to see that. But that's not good enough for me because I'm the type of person with my background, which I have a medical background. I'm a nurse, pediatric burn nurse. I'm used to numbers. I can't if I don't have the numbers, something that I can measure. That's a problem for me, right? So when I said uh when I said I didn't know how to pick my market, and then when I took Neil Bauer's course, what he gave me was the numbers that look at try to look at these numbers between this and this, between this and this. That right there gave me what I needed. But like I said, as a nurse, I know when the blood pressure is high. I know when blood sugar is high. I know when someone's considered obese. There's certain marks that we're taught as a nurse. We know. We know to get higher help, or okay, we need to refer you to the doctor or whatever. So when it comes to real estate, I look at real estate somewhat as a nurse in a nursing way. That's the reason why sometimes I say, well, what are the factors? Like, what is the numbers, right? And I like that you said there are no rule of thumbs, because you're absolutely correct. I learned that too, right? And once I started building that relationship with my property managers, then I saw, okay, the market here in Augusta is not the same as the market in Houston, and it's not the same everywhere else. So I like what you're saying. I in reference to that, and I want to get into what I want to ask one more thing that you jumped into, and that was you said shift share. That's another term that I haven't heard before.
That's correct.
Shift share. Now, can you? Because I'm also a commercial. I'm also a commercial agent with KW. So when they say the market is shifting, that when you say shift share, I'm thinking of is the market shifting. So when you say shift share, what are you referring to?
Employment. How is it
Gotcha.
shifting? So you look over a time period. That time period could be anything. The data will take us all the way back to 1990. We don't have data prior to 1990 with BLS, Bureau of Labor Statistics, which is where we get our data from. And shift share is a calculation. It's actual growth. So the actual growth of the market, and growth could be contraction. Either way, that
Right.
actual growth equals national growth, how the nation did during that time period, plus industry mix. So how the nation affected the local industry and the local market. So look at it as rising tide lifts all boats. So that tide is the US and the boats is the industry mix. So how did the industries do based on national employment plus regional shift? And regional shift is the employment or the companies that left the market or came to the market that were new. That's a regional shift. All right. So those three will give you the actual growth of the market. So if you look at Atlanta from 2017 to 2024, there was 250,000 employees that grew during that time frame. This is employment data.
Right.
Well, what were the numbers in there? How did they grow? Well, so many grew by national employment, so many grew because of industry mix, and so many grew by the regional shift. And the regional shift is your most important number. The US is a baseline, that's your baseline. And then the industry mix is just an indicator of how the industry did versus the US, and can start to identify whether the market is diverse or whether it is a one-trick pony when you do these kinds of calculations.
Gotcha.
I want to go back and talk about one thing before we move on further. You talked about
Sure, go ahead.
I want to give an example of why rule of thumbs are ridiculous. Look at Dallas. How many people are moving to Dallas a day? A lot, right?
A lot.
So riddle me this. Why has the Dallas occupancy decreased in the last 12 months by over 7%?
So if a lot of people moving in, why did it decrease? Are they going to the suburban areas?
I'm talking about the whole metro.
Oh, the whole metro. What's going on there?
Well, that's my point. Okay. You can't just look at certain numbers. You have to dig deep and find out what's going on. Affordability isn't just in mortgages. Affordability has hit every single market across the country in rents. People can't afford the rents in Dallas anymore. So the people that are moving to Dallas, they're doubling and tripling up and roommating. What do you think that does to demand? Well, it's obvious. The numbers show it. Vacancy has been increasing to the tune of 7% over the last 12 months, which means NOIs are dropping. But if you just look at population growth, you'll never know that information.
Gotcha. So, and I understand that, and that's clear because with the economy the way that it is, things are shifting and they're moving quickly, and that leads me to my next question. I was looking at your three underwriting sessions, and I see that they was dated back in 2022, and today is 2024. How much of your underwriting skills has changed, and what has changed or shifted from 2022 to 2024?
Almost nothing, except you have to look harder at interest rates, obviously. And you have to put that deeper into your underwriting because if the interest rate on the loan is higher than the cap rate that you purchased the property for, you're negative leverage. You'd be better off paying cash for the property. So that must be paid attention to today, as well as how you're purchasing. We are no longer in an expansion market. And so if you're purchasing on pro forma, you've already lost. So you have to go back to fundamental principles and you have to purchase with cash flow. Doesn't mean there can't be a value add component there, but the day you close on the property, that first month, you better be receiving a cash flow of 1.225, 1.3, whatever that lender minimum is. Okay. And while I'm on that subject, one way to identify whether you're appropriately paying for a property or not is don't believe the BS that people tell you that Fannie and Freddie think there's too much risk in the market, so they'll only give you 55 or 60% LTV. The reason they'll only give you 55 or 60% LTV is because they're capping you on your debt service coverage ratio the day you close on the property. So that's why you're getting that low LTV. But if your debt service coverage ratio is at their minimum, say 1.25, they'll give you 75% loan to value all day long. That's how you can determine whether the property is appropriately priced.
And I remember that when you said that in your videos, and that is one thing that in my underwriting, my minimum is always, well, not always, because my minimum will fluctuate, and I don't know if you may have to do it, but my minimum 1.25 or 1. My DSCR, depending on the age and the construction, the age of the build of the property, I'm going to fluctuate my DSCR to increase it a little more. So if it's an older building, then I want my DSCR to be a little higher, maybe a 1.4 or 1.5. Do you also look at or strategize in that way to where you say, okay, well, this is a new building, I'm gonna go with a 1.3, but since that's a older building, 1960, I'm gonna go with a 1.4 or 1.5. Do you strategize in that way?
So there's two ways to look at that. What I do is I'll strategize my DSCR based on where we are in the market cycle. Where we are today, I'm at a 1.4 to 1.5 because we're anticipating NOIs dropping as we enter the recession. And you have to have that cushion for NOIs to be able to drop. I'd say 20%. So if your minimum is a 1.2, go to a 1.4. If your minimum's 1.25, go to a 1.45. Give you that 20% cushion to be able to survive your NOI dropping and still be at your minimum DSCR. Now, are you going to get a deal today doing that? Probably not. But at least you're properly underwriting the deal using fundamental principles, and it's all based on your risk. So back to risk. I said there's two things. The other thing is that I look at in any part of the cycle where I start to use age, market, resident mix, everything else is my discount rate. Now, probably another term you've never heard except from me.
No, I've heard that before.
That is a fundamental term to categorize your risk. So if I'm going to invest in a deal and I'm going to pull $100,000 out of my pocket, so that's my whoop out money. I'm going to whoop out 100 grand. I'm going to give it to you to invest. I have a rate of return I want for that investment.
Right.
That is my discount rate. So it's the same, just used in different context as the internal rate of return. So when the discount rate and the internal rate of return on the property are equal, that means net present value is 0, the property is appropriately priced. But if my discount rate is 16% and the projected internal rate of return is 14%, now my discount rate is higher than the internal rate of return. My net present value is going to be negative. The amount that it is negative is the amount I have to take off the purchase price in order to meet my internal rate of return requirement. Because I want a 16%, not a 14. So you need to reduce the price this much, and net present value tells me that by that much, and I can meet my 16% internal rate of return or my discount rate.
Now, I don't know how many people here are familiar with discount rate. I'm gonna go back again about 7 years ago. The first time I heard about discount rate, I'm gonna tell you the truth, everyone. It sort of threw me off. I didn't know what the heck they were talking about. Discount rate. I'm like, what the heck is a discount rate, right? But in my underwriting tool and my underwriting model, I do have my discount rate and I do have my net present value, and I use that. Now, the reason why I'm mentioning this is because I don't know how many people here are actually familiar with that term discount rate. I had a hard time grasping it 7 years ago, trying to figure out what was this discount rate, how did it come about. And I remember doing research on it, and it was telling me the discount rate, you could take it from the stock market, you could take it from here, you could take it from anywhere. And I was like, what in the world? So I'm going to ask you, would you please explain to everyone here where the discount rate, how the discount rate is created? In other words, how do you pick your discount rate? That's what I'm going to ask, because I know for me, when I first started learning about it, man, that thing went so far over my head, I didn't understand. So can you just explain to some of us that term, how it's produced, how you come up with that discount rate?
So the discount rate, what it does is it will take, you do a 5-year pro forma. It will take the cash flows from sale at the end and discount it backwards at that percentage. That's why when the discount rate is equal to the internal rate of return, your net present value is 0. That's why, because it takes that internal rate of return and the cash flows and discounts backwards at that discount rate. How do you get to your discount rate is all a function of risk. You talked about adjusting your risk by DSCR. I adjust my risk by discount rate. And that's how discount rate is used. To give you an example, because we're all going to be different, every one of us. And your discount rate should be different for a Class A property, for a Class B property, for a Class C property. In Houston, in Dallas, in Mobile, Alabama, Atlanta, Orlando, and Charlotte, every one of them are going to have a different discount rate based on your specific risk. What is the rate of return that you want for the risk of investing in this deal, in this market, in these residents? Okay, that's what it is. It's the risk. So, where was I going with that before I went off on my tangent? Oh, it discounts it back to zero. So just think of it as your whoop out money. When the IRR and the net and the discount rate are the same, it is zero. It will tell you whether you need to pay more for the property or that you're getting a great deal and you can actually, if there's competition on the property, you can actually raise your price and still get that discount rate. Now, institutions use discount rate by measuring it against what they call their weighted average cost of capital, or WACC. And what they do is they take, all right, how much does my money cost me from their common equity, their investors, from their preferred equity, from their first loan, first lien that they're getting. All of these taken into consideration, all averaged out as their weighted average cost of capital. They will base their discount rate on some sort of percentage difference on that. So if their cost of capital is, say, 6%, their discount rate is going to be above that 6%. And they'll want some kind of spread. So if the cost is 6, usually with institutions, depending on where you are on the market, they like to see about a 1.5 to a 2% spread. So their discount rate might be 8% if their weighted average cost of capital is 6. So that's how institutions use it.
And what do you use for your discount rate? Do
It
you use
depends.
the IRR? Oh,
Well, it's
okay.
always based on the IRR.
Okay, gotcha. Okay.
Discount rate doesn't work without the IRR. Again, they're the same, just in different context.
Gotcha. Okay. Let's jump into because that's good, but I think we may have some new investors here that's really not familiar with a rent roll, that may not be familiar with a T12. I would like to share I would like to share a T12, or I'm gonna start off with a rent roll first. No, I'm gonna start off with a T12. I would like to share a T12. Oops, let's go up here. Nope, that's not a T12, everyone. That's my questions. Okay. No, let's start with the T12 right here. So, everyone, what you're looking at is a T12. It's a old T12. Can everyone see it? Because I don't want to make it too small. See if I can make it a little bigger.
Fine.
Okay, great.
It's small.
It's small. Is it bigger now?
If you can make it a little bigger.
A little bigger? Let's see what I could do here. Let's see if I can make it at a 125. All right. There we are. Okay. So here's a T12, everyone. And so David, what I would like to ask is this. When you have this document in front of you, what story are you looking for from this document?
The first thing I do is I compare my rental income for the month that I have the rent roll for.
Okay.
Because that right there is going to tell me whether they're BSing me or not. If those numbers are different, all of it's BS.
Right.
And then I'll underwrite from the rent roll because I don't need a T12.
Gotcha.
Some of the other things you can look at are how they account for their rents. This is an accrual. So that means this is the potential for the month that we're looking for. This is not the actual cash that was collected or spent, although they use accrual to do both on these.
Mm-hmm.
Really, what the accrual does is allow you to put in your potential rental income, which on this T12 is called the gross possible rent. That's actually referred to as potential rental income, or PRI. That Loss or gain to lease is if all of my units in the gross potential rent, in this case, 100% occupied for that floor plan on the highest rent, this is what we would expect to see 100% leased. That's what the gross potential rent is. The gain or loss to lease is what is actually being leased. Okay, so it's not physical vacancy. It's just, I could have got $1,200 a month because that's the highest on the rent roll, but I'm only getting $1,050. That difference is your loss to lease. Then you start to figure out what are your other vacancy and credit losses. All right, so that includes the physical vacancy, which would be vacancy loss in this case. And then you have your credit loss, which include rent concessions, bad debt, write-offs, late, other things. I see that they don't have on here what's the word I'm looking for here? A model unit could go there because that is a loss that you're taking because you're not renting that unit. So those are your vacancy and credit loss deductions. That will get you to your gross rental income. Here they're calling it net rental income, but it's actually your gross rental income. Then you add back in your other income. Now, what I don't do is anything that is variable in this, like pet fees or late fees, pet rent, non-sufficient fund fees, anything that is variable, I will not include in my T12 because it's probably going to change when we take over the property. The others that are stable, such as utility reimbursements and things like that, I will keep those in there because they will actually be steady every single month. It may vary by the number of residents you have, but it will be fairly steady. So I'll keep that in other income. What I absolutely don't want to do is I do not want my other income to make or break this deal. If the amount in other income is the difference that you need to make this deal work, you're failing. Don't ever let other income be what makes or breaks the deal. So now you started with potential rental income, you came down to gross rental income. After we add in other income, now we are at gross operating income. So from there, we should start getting into our expenses. And here we do. The expenses are everything that it takes to operate the property, not the things that do not operate the property. So if I have amortization, a property does not need a mortgage in order to operate. It can operate on cash only. So that goes what we call below the line, below the NOI line. So I start to look for things inside the expenses that include amortization or any kind of mortgage note. I'll also look for depreciation because they'll try to sneak depreciation in there to make the numbers look either good or bad. In your calculation, you should be adjusting for what property insurance is going to be for your when you take over the property. So you need to go get an insurance quote from an insurance broker. They'll be more than happy to help you out. It's their part of the underwriting because they're hoping to get that insurance business from you. Keeping in mind that on the Gulf Coast, well, any coastal property right now, coastal counties, we're talking underwriting at $2,000 a door right now for insurance. It's absolutely insane. You also want to account for what the taxes are going to be, property taxes, and you'll adjust for those two things. If you see where you know your property management company is going to charge you 10% and their property management company is charging you 8% for a smaller property, you need to adjust for that. If it's a 20 unit property and they have payroll personnel on it, and you know you're going to operate it off market or off site and not have personnel on the property, then you can adjust for that. Other than that, you leave everything the same. And then I take my NOI, that net operating income, the gross operating income minus operating expenses gets me my net operating income. I take that number, and that is what I base my cap rate on for purchase, not 2 to 3 years from now when the business plan is complete. That number that day. Okay. NOI or cap rate is a snapshot in time. And that snapshot is the day we purchase the property. Here's what the NOI is going to be the day I start operations. And that's what I base off of my purchase price for my acquisition cap rate. So I can look at those numbers. It starts to tell me that story, but it's the rent roll where I really get the story from.
All right. So then let's jump into the rent roll. Let's take a look at it.
Am I taking too long, Daryl? I see you kind of.
No. I love it. I love it. So let's take a look at the rent roll. Let me take this up a little bit. Show tabs only. There it is. So I'm going to ask the same question. The only thing the question is going to be, the question is going to be for the rent roll. When you're looking at your rent roll, what story are you looking for this rent roll to tell you?
So I'm looking to see, you've got an OM from a broker, if you got it from a broker, and you've got the T12. Does the T12 for the month, let's say this was December 2023, does the T12 and the rent roll match? That's number one. Number two, if they told me that there's no credit loss because all of the residents are current, then I can look at, well, this particular, oh, there it is right there. So you have credits. So I can look at credits, and that's probably not a good one in this one. This rent roll is lacking the balance. So this is not a good rent roll. I want to see what is the balance. So after the resident is billed and pays, what's the balance remaining? And this rent roll lacks that. So I want to see, that tells me my credit loss. And I can now measure that credit loss against what the T12 said and against what the broker said. From there, I can look at deposits, and I can see that there's not a lot of people taking deposits. I look at the leases. When are the leases expiring? And I want to look at what are they saying is market rent? What are they actually getting? And does that market rent reflect that potential rental income on the T12? And so the story I can start to get here is the owner or the property management company that currently has the property, are they doing everything they can, one, to retain tenants? Because we can see if you have a whole bunch of just new leases, and it could be that there was just a big value add or just built, so you're going to have nothing but new leases in and only a 12-month period. But if I've got a lease from 2020 to today, there's resident retention there. So I can see how good is that management company or that owner actually retaining residents, and is there an opportunity there for an improvement? So it'll start to tell me that story. And then looking at that credit loss, if there was on this rent roll a balance, I can start to see, all right, well, they didn't tell me anything about evictions, but I got 6 residents here that haven't paid in 3 months because they owe 3 times their rent amount. Now I know that there's some problems on this property. Again, there may be some opportunity there, but I may have to have a concession to have the owner pay for those evictions, either at closing or have them evicted before I take over the property. So these are the kinds of stories it starts to tell me, and I can balance the vacancy and the credit loss and the rent amount that was charged and the potential rental income from the rent roll on the T12.
Now, when you're looking at your rent roll, I want to ask this right here. How do you, no, I'm not going to say do you, I'm going to say, how do you look at your NTVs? If you see that there, no, I'm just going to leave it right there. How do you look at your NTVs on your rent roll?
Remind me what NTV is?
Notice to vacate.
Oh yeah, notice to vacate. Okay, duh. That tells me that there's bad management in place, or if the ownership is managing bad ownership, or that the management company may be hamstringed by ownership. In either case, that could be what's happening. And there may be, you'll have to ask the question to the broker when they were presented with their lease renewal, what was the rent bump that they were presented with? And this could tell you that they're moving because the rent bump was too much, which has everything to do with affordability. The last thing I'll tell you is a lot of these owners have been just raising rents and it wasn't market driven. They just raised rents because a broker told them they could, and there was proof that 10 out of 200 units were able to get this rent. That's all fine and good. You got this nice, shiny new unit. The resident moves in and they think, okay, I can push this. I can make it happen. I can make it work. And at the end of 12 months, they're like, holy crap, I'm now in debt. I've had to pay the last 4 months on my credit card. I got to go find something cheaper. And whoop, off they go. They're out. So in the last 2 to 3 years, we're seeing a lot of 12-month leases not renew because of affordability reasons. Or they will renew, but they'll renew with a roommate moving in.
I'm not going to take I'm going to leave 10 minutes for people to ask questions. I'm going to tell you, I could go when it comes to underwriting, and I'm going to let everybody know this, which you may already know. I love underwriting. I've taken several courses on underwriting, and I've gotten mentors just specifically for underwriting.
Can I recommend something?
Sure.
And Jim Biggs, who's on here, is now doing it. Follow Jim's lead and go take CI 101, 102, and 104 with CCIM. Even if you don't want the designation, take those 3 courses and you'll know more about underwriting than 90% of the multifamily community.
Okay. I did take a CCIM course. I just don't remember which one.
Excuse me, this is Manny.
Hold on, man. You got to raise your hand.
I'm sorry.
Raise your hand. Okay, raise your hand for me. So, if anyone wants to ask a question, let me see if there's because I know some people have been putting questions in the chat. Let me just see if there's anything there. All right, Kay, stay strong.
Let me answer Alicia's question real quick, if you don't mind, Darryl.
Yeah, go ahead. Go ahead.
So, Alicia, because you don't have existing rents, you have no choice. It has to be on pro forma. But what you must do and what the lender is going to require is what's known as a feasibility analysis. So everything I talked about when looking at a market, that employment, the shift share, looking at the demand and supply, where it is in the market cycle, and then measuring what the rents are in the market and where you think they're trending. And CoStar is a great tool. I know Darryl has CoStar, or used to anyway. It's a great tool for going back 20 years and seeing how rents are trending. I would caution you on looking year over year. Everybody talks year over year, year over year. That's all fine and dandy, but if you look at it quarter over quarter, and CoStar will show it to you quarter over quarter, now you can see what the trends are over the last 12 months. And so you can anticipate in 2 years or 3 years when that delivery occurs and we start to do lease up, what can my rents be in that 2 to 3 years? And now you have all the data to back it up, put it in front of the lender so you can get your loan.
Awesome. Thank you. How do you treat, because I know that when you talked about those markets, how do you treat when that property is nearby a university?
It depends. Do you want it student, or do you want it conventional, or do you want it senior, or do you want it low income? Just because it's by a university doesn't mean it's going to be student.
Okay, but when you're looking at that, because I don't want it to be student only. I want it to have a mix, because if you have student only, there's some risks to that.
You have to, when you do your feasibility, one of the things you do is called a threshold analysis.
Mhm.
And the threshold analysis will tell you whether that specific trade area where that property is located, and I'm not talking about a 1 mile ring, that's ridiculous. You actually draw out where your direct competitors are. So it's usually outlined by major highways, rivers, railroad tracks, cemeteries, things like that, that box you in an area where your direct competition is located. If you take the demographics from that specific location, you can then determine what the threshold analysis is based on what the median household income is for that specific area and what rents you need to achieve to make the deal work, and see if you have a gap there.
Okay, thank you.
Does anyone else have a question for Mr. Monroe?
I think
No?
Emmanuel had a question.
Who had it? Yeah, Emmanuel. Yeah, Emmanuel, you had a question.
So Manny, there's 4. They used to be called core courses. They're being changed to designation courses. They're CI 101, 102, 103, 104. 101 is financial analysis. It will teach you all those definitions like discount rate, internal rate of return, net present value, all that stuff we've been talking about today. 102 is what I teach. That's market analysis. Neil Bawa needs to take my class. 103 is user decision analysis. So that's really commercial leasing, not resident leasing, commercial leasing, a owner occupied commercial property. That's user analysis. And 104, I like to call it 101 on steroids. It's investor analysis. So now you start getting into things like 1031 exchange, capital accumulation, depreciation schedules, and everything else. Things that you do as an investor. Do we hold? Do we sell? Do we go out and buy something new? All those analysis that you could put data to. Those are the CCIM designation courses. The ones I recommend for multifamily are 101, 102, and 104.
Fantastic.
Thank you.
The course that I took, let me show you. This was the course that I took right here. It was calculating value for investment and rental properties. I took that back in on my birthday, August the 8th, in 2019. That was the course that I took and completed. But I will be, when it comes to underwriting, I like to talk with underwriters. I like to take courses from different underwriters. I like to see how different people underwrite their properties to learn from and to expand and to grow, because I'm looking at really wanting to get so deep into underwriting that it's I just love underwriting. That's all I can say. Right. So we have 3 minutes. David, tell everyone, if they would, how can someone get in contact with you? Also, talk about your coaching program. Like you said you had it. I don't know if you still do, but tell everybody how to get in contact with you and what you have, what you do.
So, DavidMonroeCCIM.com it's like a link tree page, but it's not link tree. It's my own template that I built in my new system called Acquisition Pro, which is a all-in-one CRM, landing pages, calendar, pipeline, automations, everything you need to run your business. I've started a new tech company with that. And you can get access to that from DavidMonroeCCIM.com. My YouTube channel is at DavidMonroeCCIM, which is where all my education is. I had a what do you call it? Not an epiphany, but like a manifesto in December. My 2024 manifesto was to just take all of the education that I've charged at least $1,000 for over the last 3 years and throw it up on YouTube for free. And so that's what I've been doing. And it's all there now. The only thing that's not there is my strategic acquisition workshop, which I'm going to start re-recording and updating like Daryl said, it's been 2 years since I've updated it. So I'm going to redo my strategic acquisition workshop, formerly strategic partnering workshop, starting in about 3 or 4 weeks. But that's how you get a hold of me. That's how you can connect with me. The other thing he talked about, the coaching. I don't really do coaching anymore, but we do have a certification that we started. I say we because I've partnered with Charles Seaman and Ryan Murphy of Cash Flow Champs. Now, Cash Flow Champs themselves is not part of the certification, but Ryan and Charles are, where we provide, we call it the strategic acquisition certification. We can provide you with a certification and then introduce you to other syndicators if you want a specific role on their GP teams, having this certification in place. What separates it from everything else is the practical application. You actually get on asset management calls. We actually do complete due diligence on property Charles and Ryan own in Atlanta, Mississippi, South Carolina, and North Carolina, where you go through the whole due diligence package, everything you would do in due diligence. That way they can see on their properties what's happening and report it to their lender and insurance company and make them look like heroes. So it's a good fit for both of us. So there's a lot of practical application in it that you don't get with some stupid coaching program. So if you're interested in that, there's places to connect with me on my davidmonroeccim.com. Be glad to have a conversation with you. But other than that, that's it.
All right. All
Easy
right.
to get a hold of.
Fantastic. Well, listen, I want to thank you for coming. I'm going to tell you, the information that you have provided to me is priceless. And I always like to say, some people drop golden nuggets. I think David dropped platinum nuggets. I think platinum is way better than golden. So he threw out a lot of information. And if you're not familiar with some of the things that he had said, I'm gonna tell you right now, go to YouTube, put his name in, David Monroe CCIM, right? And take a look at the courses that was for underwriting, and you'll learn a lot. You really will. So, David, I want to say thank you for coming. Thank you for being a guest on today's Commercial Multifamily Mastermind. I would like to work with you on underwriting and to learn some more because I'm always looking at growing. I'm in, my brain is wanting to grow in underwriting. So I want to thank you. Thank you for your time. Thank you for coming. And I want to thank everyone for coming. Let's give David Monroe a round of applause for being here. If you could clap, or if you could give the little hand clap up in the cymbals, but I want to say thank you. Thank you for coming. Now,
appreciate your invite, Daryl. It's a pleasure being here.
Fantastic. And let's stay in touch, man. Let's stay in touch. I know you're busy. I know you're busy.